Chairman Bernanke, I just want to start for purposes of memory, because we often seem to have short-term memory here. November of 2008, and the time, and I think you reference it to some degree in your opening statement. November 2008, after those presidential elections, you and Secretary Paulson came before members of this committee and basically said, you know, we have a emergent set of circumstances, and we need you to act, to do so boldly, and in the absence of doing that, that we would have a global financial meltdown. So I want to start there because it's the beginning of what has then transcended since then. Is that pretty much a fair statement?
Yes, sir, except that was October. It was early October.
October, yeah. Okay. And then the actions took place thereof. So, because I often get from my constituents back in New Jersey, you know, Senator, when I make a mistake, I have to pay for it. And it seems when these financial institutions make a mistake, I have to pay for it too. And I think that the difficulty is creating the connection between why we acted based upon the expertise of yourself and others who said we needed to do so because otherwise there'd be a global financial meltdown, and that obviously has real-life consequences to Main Street in New Jersey, or for that fact across the country. Is that a fair statement?
Of course.
Now, which brings me to where we are today. And I want to get a sense from you, do you believe that the American economy is recovering?
It's beginning to grow again. We'd like it to grow faster. We'd like jobs to come back faster, but we avoided, I do believe, we avoided a even far worse situation by avoiding the collapse of the financial system, as you indicated.
Mm-hmm. And to give us a sense, when we say we avoid it, because you know, I think Senator Bai mentioned that, or maybe Senator Schumer, or both, mentioned that sometimes when you avoid harm from happening, you get no credit for it. But give us a sense of what would have happened had we just, let's say, you know, let the markets do it on their own. Let them figure it out.
Well, my professional career before I came to the Fed was as a scholar or academic studying financial crises and their effects on the economy, including the Great Depression. And there's a lot of evidence, not just in the United States, but many other countries, that when the financial system collapses or melts down, that it has very, very serious effects on the broad economy. And I think just the fact that the Lehman Brothers and the associated instability around that period contributed to a global recession is evidence for that point. It's my belief that if we had not acted, if Congress had not supported our actions to stabilize the system, if we and our partners in other countries had not worked together in those weeks in October to prevent what, in my view, would have been a collapse, a meltdown of many of the major banks in the world, that we could very well be in a depression-like situation with much higher unemployment than today, very deep decline in output, and no immediate prospects for a recovery, unlike the situation we have today, where we do see the economy growing. So I think the risks of allowing that meltdown were enormous, and the costs to the economy, to the taxpayer, to the average worker, to the average person of allowing the financial system to collapse. The financial system is like the nervous system of the economy, and if it breaks down, you get much broader consequences. So it's been a very hard message to explain, but it's extraordinarily important to understand that I did not intervene because I care about Wall Street. I am not a Wall Street person. I'm an academic. I come from a small town. I did it because I knew from my studies that the collapse of the financial system would have extraordinarily bad consequences for Main Street. And that is why we did what we did, and I firmly believe we did the right thing.
So now December 2009, I asked you whether the economy is recovering. You answered, it is growing. Growth doesn't necessarily mean recovery then.
Well, it's technically a recovery in that it's growing, in that we're no longer declining, but it is certainly not a satisfactory situation since we have a 10% unemployment rate.
We agree on that. So what do you believe is the most significant threat to our economic expansion, both in the short term and in the long term?
Well, there are multiple concerns. Certainly one of them is that it still remains difficult to get credit, particularly for bank-dependent firms. That's preventing small businesses from hiring and from expanding. The high unemployment rate is a major concern because we're seeing not just 10% unemployment, but we're seeing very long duration of unemployment. We're seeing a lot of people on part-time work or in short hours. And that has implications not just for the short term, but for the skills and labor market attachment of workers going forward. It's going to affect people for many, many years. There are additional issues like our external trade deficit, the fiscal deficit, and so on that we do need to address. But in terms of the immediate recovery, as I talked about in a speech I gave in New York a couple of weeks ago, I think the two issues we need to watch most closely are the return, the healing of the credit system, particularly for smaller borrowers, and the labor market, which is, of course, still in great stress.
And we seem not to have succeeded at dealing with the credit market in a way that meets some of our goals that are critical to also deal with our unemployment consequences. And, you know, I look at where some of the major institutions are getting the credit. They're getting credit, you know, easily 2 points lower than some strong regional entities. And that's probably what's keeping them largely afloat. But the question is, as you do that at the Fed, where is the movement here, the hammer, for lack of a better, you know, to get them to loosen up the credit, and what can the Fed do to move it in a direction that also is going to begin to make a real significant impact on unemployment, the two things that you say are critical?
Well, on unemployment, we have a range of policies, including low interest rates and mortgage-backed securities purchases and a variety of other things. On credit, it's a difficult thing. I think it's a mistake to tell banks you must lend such and such amount because we got into trouble in the first place with bad loans. We want them to make good loans. We want to make loans to creditworthy borrowers. So the Fed and the other banking agencies have been working with the banks to try to make sure that they are not, either by examiners or on their own account, failing to make loans to creditworthy borrowers. So we have issued guidance about the importance of doing that. We have trained our examiners to look at both sides to make sure that that banks are giving full weight to the importance of continuing relationships that they have with, for example, small business borrowers. We have issued guidance with detailed examples for how to deal with a borrower who may be making payments but whose collateral, which may be his business, has declined in value, that it still might be important to continue lending to that person or that business. And in addition, we have been trying to strengthen what's called the shadow banking system through our program to increase securitization of small business loans, commercial real estate loans, and the like. So we're addressing this. We did the stress test to get banks to raise capital. So we are working at this. We understand the critical central importance of this. It's not going to be a quick improvement, but I do think we are seeing some improvement, and as the economy strengthens, there'll be a mutually beneficial improvement in the economy and in the credit markets.
Well, this is clearly the singular most important.
I agree.
I know there's many other issues that the Fed deals with, and, you know, but this is the singular most important issue that your chairmanship is going to be critical over in terms of helping us move this country forward in a way that its economy is recovering more robustly, that unemployment is being reduced, and that we give people back the dignity of work, which is ultimately the opportunity to sustain their hopes and dreams and aspirations. So I'm going to be looking at what you're doing in that respect incredibly closely. And my time is up, but I do want to visit with you about the Consumer Financial Protection Agency. When you came to see me, we had some original conversations with that. But, you know, my one criticism, I think you've done a lot of hard work in difficult times. My one criticism, which really precedes your time even, but continued during your time, is that the Fed had broad powers in consumer financial protection, and it just didn't use it in a timely fashion. And so there are many of us who question that leaving that there is not necessarily in the best interests of the country. So I look forward to having a discussion with you on that.
Senator, just quickly, I don't disagree with we were late in using those powers, but over the past 3 years or so under my chairmanship, we have actually been very active in a wide variety of areas of consumer protection.